I'm John Lopez.
And I'm Lou Guglielmetti, and we are managing partners with Asset Preservation Michigan.
Are you about to retire soon? Do you already have the date marked on your calendar and the time you're leaving your current employer? Let our firm help you, whether it's to see what kind of risk you're taking in your portfolio or to the extent of creating an estate plan to avoid probate. Let us create a unique plan for just you and your loved ones.
We specialize in all areas of retirement, including Social Security planning, tax and income planning, retirement rollovers such as 401ks, IRAs, and pension buyouts. Our goal is to provide peace of mind before and into retirement. My name is Lou Guglielmetti with Asset Preservation, and I'm going to be talking about retirement strategies to minimize your taxes for those future retirement years. A little bit about Asset Preservation. We were founded in February of '97. Our Asset Preservation advisors pride themselves on guiding clients through retirement plan development, education, implementation, and our time-tested strategies have proven our clients with consistent growth, safety, peace of mind, and lasting success. We are A+ rated on the Better Business Bureau, and we safely manage over $350 million in retirement accounts. So what is provisional income? Provisional income is half of your Social Security plus lines 7A through 19. So if you will notice on this chart, this is what is looked at to develop what type of tax planning you may have available to you. Will your benefits, meaning Social Security benefits, be taxable? So if you make less than $25,000 as an individual filer in provisional income, you will pay 0% on your Social Security taxes. If you make between $25,000 and $34,000 in provisional income, you will pay taxes on 50% of your benefits. And then over $34,000, you will pay over 85% in taxes on your Social Security benefits. For married filing jointly, the numbers do increase a little bit. So if you make less than $32,000, 0% of your benefits are taxable. Between $32,000 and $44,000 in provisional income, 50% of your benefits are taxable. And then over $44,000, you'll pay 85% of your benefits will be subject to taxes. A little example we want to discuss real quick. We met a lady back in 2011, and she had unfortunately just lost a loved one. And she had some tax problems. She had some issues with some properties, some retirement accounts. She was referred by a friend, and she wanted to see how she can minimize her taxes moving forward. So that was the main goal when we met with her. So we looked at their Social Security based on what is shown on your screen. There was a lot of things going on. There were some IRA distributions, a little capital loss. There was a lot of different things, but we would like to refer to line 20A on your tax return, or 1040. And that's what Social Security benefits you receive. In this example, it shows a number of $21,912 when we first met her and what she was collecting. When we look at the line 20B, that's the amount of Social Security that is subject to taxes. Okay, so she was paying over 85%, taxes on 85% of her Social Security benefits. We fast forward 1 year to 2012, and we look at Social Security. She did get a cost of living adjustment, as we discussed before, and her number went up to $22,703. But after adjusting a few of the assets, looking at minimizing that bottom line of taxes, we came down to a number of $8,000 out of the $22,000 to be subject to ordinary tax rates. Then we fast forward to 2014, another 3 years later, and we noticed that her Social Security benefits did get another cost of living adjustment, so she's now up to $23,424. But after moving some of the assets into different non-taxable accounts, she was able to not pay any taxes on her Social Security benefits. Now, does this happen to everyone? Absolutely not. But most people that we do meet with, we can minimize those taxes for the future. Required minimum distributions, or RMDs as we refer to, and the Secure Act of 2019. RMDs are very important because those are mandatory distributions that you must start taking at age 72 now. It used to be age 70 and a half, and let's talk about that change in the Secure Act of 2019. On December 20th of 2019, President Trump signed the Secure Act, setting every community up for retirement enhancement. And what I'm going to do is just highlight some of the different changes that are going to be experienced by some of the retirees moving forward. First and foremost, it's easier for small employers now to offer bigger retirement plans. So for example, someone that has a little small business may now be eligible to join a larger group, like a Ford, like a Chrysler, General Motors. So some of these smaller companies can offer their employees a bigger plan and get a lot better benefits in their retirement accounts. Second, and probably one of the most highlighted options out there, is raising the required minimum distribution age from 70 and a half to 72. Now this is a positive because it now gives some of the retirees more time to do some of the tax planning and reducing those taxes over time. Number three, it's also offering traditional IRA contributions allowable till any age. So it doesn't matter if you're 75. You can still contribute to a retirement plan or an IRA, 401k of some sort. So for those of you that decide to work past a certain time, they want to work till they pass, you can now contribute to a plan up to those ages. Most important highlight is the fourth on here, and that's the stretch IRA. The stretch IRA, some of you may have heard of that term before, but it allowed a beneficiary to inherit an IRA and stretch it out over their lifetime, allowing them to do two things: minimize their taxes over that lifetime and still provide some income for that next generation or generations to come. That stretch IRA is now being replaced with a 10-year payout. What that means is if you are a beneficiary of an IRA, a non-spousal beneficiary, you must distribute that IRA over a minimum of or a maximum of 10 years. So again, this is going to bring some tax dollars to the government, the IRS. That was the goal of this. So there are some positives to this law, but there are also some drawbacks. Required minimum distributions are mandatory distributions that must be taken from your retirement accounts at age 72. That first distribution is 3.64%. And that distribution percentage is based upon the total of all your IRA or 401k accounts. So nowadays, it's not unlikely that we run into people who have 3 or 4 different retirement accounts. Remember, it's the combined amount of that. Age 75 is 4.36, age 80 is 5.34%, and age 85 is 6.75%. So that percentage goes up over time. Remember, these accounts have never been taxed. So Uncle Sam wants to eventually get some tax dollars from these accounts. Now, most importantly, if you forget to take a distribution or an RMD in any given year that you are mandatory supposed to take of, you will be penalized from the IRS for 50% of that amount. So it's very, very important to be aware, obviously, when you're turning 72 and then on every year after that. So a lot of people have it set up automatically, or the company that they're working with will send them a notice on that required distribution they're supposed to take out from that account. Remember, you can have multiple accounts. So very important. Let's look at an example. We have a gentleman or lady who has retirement accounts totaling $500,000. At age 80, that required distribution percentage is 5.34%. So we times that by the $500,000. We come up with a mandatory distribution of $26,700. Now, let's say he or she goes on a trip to Europe that year and doesn't have it set up automatically, and they forget about it. They will be penalized 50%, which equals $13,350. Now, it's up to them if they want to take money out of their checking account or savings account, if they keep that much in there, to pay that penalty. But what do most people do? They take it out of the same taxable account. So now we have a distribution of over $40,000 taxable. But most important, if this distribution was supposed to be taken in 2019 and we forgot, what do we have to do in 2020? We have to take 2 distributions. So let's just use that number of 26,700, that's times that times 2, and add the penalty of 13,350. That's over a $65,000 taxable distribution in 1 year. Yeah, it's probably going to cause some tax problems. So we look at ideas to avoid and minimize those taxes and minimize these penalties moving forward. And we talk about tax planning. And a big tax planning tool nowadays with the new tax laws is Roth IRA conversions. Everyone's heard of Roth IRAs, right? Roth IRAs are after-tax retirement accounts. So you don't have to pay taxes on those accounts. In fact, you don't have to pay taxes on the earnings or the distributions, or the beneficiaries don't have to pay taxes as well. So there's 3 positives to that. So we talk about a Roth conversion. That means converting from a traditional IRA or pre-taxed account to a Roth IRA after-tax account. Yes, you do have to pay taxes in that given year, but that's why you do partial conversions. You're not going to roll over the full IRA account. That would cause a absolute debacle with your taxes that year. We don't use income limitations. There's no tax, as I mentioned, on the future earnings or the distributions of a Roth IRA. And they're not subject to the RMD, or the required minimum distributions. So when the IRS looks at those accounts when you turn 72 and older, they don't pay attention to the Roth IRA. They're only looking at the pre-taxed accounts that have not been taxed. So the Roth does not show up on that schedule. I want to bring up the 2020 income tax brackets because I feel that they're important. Meaning that is that the tax rates have been reduced. So the 15% tax bracket used to be the 12% tax bracket. What we're going to do is we're going to pick on a married couple today. So a married couple, normally without any debt and big expenses, they can live within the 12% tax bracket, which is up to $80,250. And remember, under the new tax laws, we do get a doubled standard deduction for married couples, which is increased from $12,000 to $24,000. So let's take a look at an example. Most married couples can live on $5,000 a month without a mortgage, without some big expenses. They might need some money to spoil the grandkids or so, but $60,000 would be the annual income that they would need over time. So some married couple that makes $60,000, remember, they get a standard deduction of $24,000, which is doubled, as I mentioned before. That now gives them a taxable income of $36,000. Remember, the tax brackets of 12%, that $36,000 falls in the 12% tax bracket. But wait a second. We can actually make up to $80,250 and still remain in the 12% tax bracket. So what does that mean? That we subtract the $36,000 from the $80,250, that gives us $44,000 or more of room to convert from a traditional IRA to a Roth IRA. Okay, why do you do that? Because you're creating some tax-free accounts, obviously, but you're also reducing that required minimum distribution that you will have to take out in the later years and for the rest of your life. So, very important. Let's look at an example of this. So we pull up a 1040, and I'm just highlighting some of the lines on the 1040 of this married couple. If spouse 1 is expecting $30,000 in Social Security on an annual basis, spouse 2 is expecting $18,000. If you notice, I highlighted 2 lines. That's line 15B, which is your IRA distribution line. In this case, it's the required minimum distribution that a client must take over time. So in the first column, without planning, you see $20,000 as a required minimum distribution. On the second line, with tax planning, we show $10,000. So what I'm showing here, or meaning here, is this particular married couple would be able to convert half of their traditional IRA accounts into Roth prior to the age of 72 when those RMDs kick in. So when we look at the bottom line of those numbers, we show the tax. And the tax on the column without planning is $7,546.92. The column with planning shows a tax of $3,788. That's a tax savings of $3,788 a year post 72. This is 1 year. This is not including the rest of the years for the remainder of their lives. So you can say there's some big tax planning on minimizing moving forward. Now we're going to talk a little bit about market risk, and I just want to highlight a few things based on the volatility of the markets nowadays. We obviously had a tragedy or a pandemic come through that's causing some volatility, so we want to talk about a little bit of a history of the S&P 500. Everyone's heard of the S&P 500. In fact, most of you watching this probably own this fund in one of the funds that you have. Whether it's your 401k or IRA, this index is probably in one of those funds. So we look at a little history of the S&P 500, and we want to pick up from 1960 through the end of 2017. And what I'm trying to accomplish with showing you this is a little bit of the peaks and valleys of this particular fund and why they happen. During the 70s and 80s, we had a generation entering the workforce called the baby boomers. The baby boomers made up 37% of the population during this period of time. In fact, they make up about 80 million right now in our country. And 10,000 of them a day are turning 65. So during this period, they entered the workforce and they were offered different retirement plans. They were offered a pension plan, a lot of them were, also offered an IRA or 401k plan on top of their pensions. So they decided to contribute to a plan, take a little bit out of their check every week, and put an influx of money into the stock market. And during the 80s and 90s, we started to see this heavy increase in the market. And we noticed during the 90s, it was called the tech boom. We then reached a period of time where everyone thought the world was going to end in January 1 of 2000. And we saw this increase. And what happened in January 1 of 2000? Absolutely nothing. But people loaded up on items. They fed the economy with new computers, new cameras, new printers. They had everything new. So they had fed the economy during this period of time. So they didn't really have to buy things after 2000. There was also a Microsoft bubble, or a Microsoft lawsuit in March of 2000. The buildings got knocked over. Our World Trade Center got demolished with the terrorists, unfortunately, on 9/11. And we've seen a heavy decline in the market. In fact, over 30 to 40%. Then March of 2002, we started to see an increase in the markets, in the S&P 500. And we reached another peak of October of 2007, which was considered the recession. People were losing their jobs, losing homes, and didn't really know what to do. We saw a steady decrease in the market of over 50% in the S&P 500. Some people didn't know if they were going to be able to ever retire based on how their accounts had declined over time. And since March of 2009, we've seen this steady increase, actually this bull market. This bull market decided to roar up until March of 2020 when we hit the coronavirus. So now we're seeing this volatility, and we're seeing 10,000 baby boomers wanting to retire or turn 65 every year. Remember who was feeding this market during this period of time. What are they all trying to do now? They're trying to retire. And we have a generation coming in. We have the millennial generation as well as the X generation. The X generation makes up a lot less. The millennial generation is a lot larger. But how many of are actually contributing to these types of plans? So will there be the demand? That's up to question. The main point of this slide is to show you some of the peaks and valleys and the risks that may be taken. We know over time, obviously, you must be much more conservative as you approach retirement. This slide is new math for retirees. We wanted to point out obviously with a 25% loss, which we've seen recently, can cause $100,000 to go into to turn into $75,000. You actually have to make 33% on that $75,000 to get back up to your $100,000. A lot of people don't look at that. They say they lost $25,000, well, or 25%. I've got to earn 25% to get back up to even. That's not true. So there's 3 phases to your money. There's the accumulation phase. Again, those are in your younger years. Obviously, when you're working, you can take more risk. You can get into different funds. You can buy different stocks. You can kind of play the market. It's a little bit different as of then because you're contributing, right? Then we move into the distribution and preservation phases. Obviously, we have to decide on to start using some of this money to supplement our Social Security. So how do we do that? What accounts do we take from? What accounts may cause less tax liability than the other? And then preservation. We want to keep our assets. We not only want to keep our assets, but we want to keep them for the next generation or the heirs. We want to make sure they're there. We don't want attorneys or the states to get involved. We want to make sure it's preserved and transferred appropriately. So we look at the rule of 100. And the rule of 100 shows us you take your age, you subtract that from 100. That is the maximum amount of assets that you should have at risk. And what I mean by risk is that they can go down. So at a certain point, you have to look at that and say, what percentage of my assets cannot go down? Most people, when they do approach retirement, most of their assets can, and they do have the risk. So what type of risks are you taking at this point? And we obviously know that over time. So this football field just shows you those different phases: the accumulation, the distribution, and the preservation phase. Everybody's plan's different. Everyone's got different goals. Everyone's got different income needs. Everyone's got different Social Security benefits, different pension benefits. So it really comes down to what your individual goals are moving forward and what you want in retirement. So why is planning so important? We look at the pie chart and we show Social Security makes up about 33% of the pie chart. And we look at earnings, which make up about 32%, and those are obviously growing as well. And then we look at savings and investments, which have grown over time as well, which make up about 10%. The one part of the pie chart, which is the purple, that we are seeing a decline in is pensions. That's why it's making planning so important. More people are having to rely on their retirement accounts and retirement assets to supplement their Social Security. So how do you do that most tax efficiently? So there's steps in the planning process. You want to gather the information. You want to get that wage info from SSA.gov. You want to know when you're going to retire or have a good idea when that time frame is. Can you retire? And what's your life expectancy? Again, what I refer to as your shelf life. How long are you going to live? A lot of people are living well past their 90s. In fact, a married couple, the percentage of one of them living past 90 is well over 50% now. Creating the Social Security plan. Filing now versus filing later. What's the difference? Is there any strategies available for you if you've had an ex-spouse or a past spouse? What benefits are you entitled to? What's at stake? Again, is it $20,000 over a lifetime? Or is it $200,000? That might influence your decision a little bit more. And most importantly, the third column, identifying those income gaps and tax traps. I can't tell you how many people we sit down with and run a tax report for them and see that they're paying an obscene amount of money in taxes for the rest of their life. So they catch themselves in a tax trap. So again, what are your income needs? What are those desired income needs? We know you have needs and wants. What are those future tax ramifications on those retirement accounts? Some may be taxed at different rates than others. How do we avoid those larger tax obligations moving forward? And most importantly, how to fill that gap most tax efficiently. So you might have an income of Social Security. You may have a pension, if you're lucky. How do you supplement those retirement accounts to make up that desired need most tax efficiently? To receive a complimentary income tax planning report or risk analysis, please call us at 586-383-0178.